All right, I got good news and I got bad news, because while the markets keep climbing, and that's good, so does our national debt, and that is bad. We are now standing at $20 trillion. Yes, trillion, with a T. Maria Bartiromo asked Treasury Secretary Steve Mnuchin about exactly that. Listen to what he said.
Well, let me just say, I mean, the absolute level of debt is a concern for me and a concern for the president. And as you mentioned, under the last administration, they doubled the debt. Having said that, our number one focus is economic growth. We need to get to economic growth to solve the issues that we have in this country. So the debt is a longer-term issue, not a shorter-term issue, but absolutely something that we're focused on as well.
So it sounds like getting a handle on entitlement spending and our national debt isn't a top priority right now. But as he pointed out, Trish, it had doubled over the last 8 years. So it's not as though this just happened overnight. It's been building over the last 8 years.
What do you do about it now, especially when you want to spend a lot of money? Let's go to our Fox Business All-Stars, Cheryl, Casone, and David Asman. What do you think? I mean, if you were going to prioritize things right now, David, is it economic growth or dealing with debt?
It's economic growth. I think both Mnuchin and the president have it exactly right. The president, by the way, said pretty much the same thing in a Fox News interview with Bill O'Reilly. He said that there are times when you got to worry about the debt, but now we have to worry about growth. There are times when you have to prime the pump a little more, even if the well is getting kind of low, you still got to prime the pump. And this is the time to prime the pump. Yes, it's a worry. By the way, the deficit is up as well. The year-by-year deficit, for the first time in 3 years, the 2016 deficit increased by $148 billion to $587 billion. So we got to tackle spending. Spending is a big problem, and he's got a good person in the budget department to oversee that. A guy from Heritage Foundation who came out with a blueprint about how to cut the expenses. So cut the expenses of government, focus on tax reduction, and growth will take care of the rest.
The real problem, I think, is the servicing of the debt. And I actually beg to differ here. I believe that the debt needs to be addressed just equally as strong as economic growth. They've got a plan for that, but they don't really have a plan for that debt. When you look at what that $20 trillion number, $14.5 billion of that right now is public. Half of that is owned by foreign governments. At a time where maybe our relationships with these foreign governments are maybe going to get a lot.
With the low interest rates, it's not that bad.
They're not going to be low. They're not going to be low for much longer.
Look at how high they were in the early 80s. That was the same thing that people said against the Reagan tax cuts. They said, no, we got to worry about the debt. Back then, we had interest rates at 14, 15, 16%. You and I remember. The ladies don't, but it was terrible. And yet, we got the debt under control by growth back then. We did the same thing. And Reagan said, the heck with it. We're going to go with the tax cuts. I don't care about the debt. We need to prime the pump. And he turned out to be right.
Well, the bond king, Jeffrey Gundlach, when he was on this program and made that first prediction that Donald Trump will win the election over a year ago now, he also made the point that Trump is a guy who's very comfortable with debt. Now, the fact that he's comfortable with debt is that he has found how to manage the cycles. But I agree with Cheryl that there will be a point when rates start to move up. If they do start to move up, that servicing the debt will become a concern.
Why wasn't it in the 80s when we had 18% interest rates?
The reason, David, is because at that time, there was not this idea that interest rates was such a driving impact on the overall global economy. We weren't as interlinked as we were in the 80s as we are today. I want to give you credit on something that you said at the end of the year on this program about the markets. We're now 2 months into the year, and you said the markets were going to continue to run, and I have to give you credit for that.
Absolutely.
But do you feel that the stock market has gotten ahead of itself in terms of all of these expectations being built into the market?
Well, you know, the funny thing is people were saying during the last 4 years of the Obama administration, wow, this market is just going bonanzas. But remember where it started. Remember how badly it was hurt by the financial crisis. When you take a look at if you X out the financial crisis, I know it's hard to do, but you just look at where the market was before the financial crisis. And yes, it was a little overblown back then, but not too much. It's been pretty steady rise, and it had a lot more to go. It had a lot more to go, but it was stopped by those 1% growth rates all during the Obama administration. I mean, we had the most pathetic growth rate in history during the Obama administration. And even though the market was going up, the economy was pulling it down. So now that it's been released, the thing is we have to see action on tax cuts. If we don't see action, I'm finally beginning to get not bearish, but thinking that the market has topped out. because they're waiting for action on tax cuts. If they see that delayed much longer, then the market might actually pull back a little.
Cheryl, you think about those 8 years, and what was the overall average? Something like 1.2%.
1.6%, I think.
Lousy,
like
right? I mean, we didn't even hit 2.
Yeah.
Now we have this opportunity. You get the Fed, though, however, in the background, it was helping things along back then, the only game in town, and now they actually have to do their job and raise rates at some point. So with all that in mind, can we really start to see, I don't know, 4%? 5%, dare I say 6% economic growth? Can't you see Donald Trump out there with the GDP sign saying, check this out, how much the economy is growing? I mean, what's it going to take to really start to rev the engine?
Well, I think that we're in the beginning stages of that. I certainly think that a lot of his economic plans, I believe a lot of those plans getting him elected president in the first place, are great ideas. The implementation, of course, he's got to deal with Congress. That's going to be another sore subject probably for him. But 3% growth, 4% growth. If you listen to Steve Mnuchin, who was on Fox Business when he first was appointed by Donald Trump, even before he was confirmed as Treasury Secretary, he said, I am going to go for 3 to 4% growth. He wants to see that. He backed off that a little bit with Maria, I'm going to be honest with you, this week. But at the same time, long term, I think he's thinking 4%. I think he's more realistic about than a 6%.
Can I just remind
Donald
you?
Trump, though,
back to the Reagan years, as we talked
well,
about.
let's look at the Reagan years. Donald Trump doesn't want that.
1984. Remember the growth rate in 1984? 7.4%.
Yeah.
For the whole year, 7.4%.
But what was your mortgage, David? Didn't you tell me it was 16% that year?
High mortgages.
We had that discussion.
Very high mortgages.
High interest rates with high growth is a good thing. And Cheryl and David, thanks for joining us.